Hi, my name is Max. Welcome to our economic channel, Max Economics. Cheap money. If you have watched an economic news program in the last months, you have surely heard the expression cheap money. Maybe hearing it made you wonder, are there more types of money? How does cheap money differ from regular money? Well, their nominal value is the same. The difference is the cost of obtaining them. We all know that money is hard to get and we struggle to obtain it. We have to work, at least 8 hours each day, to obtain a wage that probably is just covering our basic needs. So, when we hear that somewhere out there you can find cheap money, we can't stop wondering. How can be money cheap when we are literally exhausted from obtaining them? Truth be told, cheap money is not cheap for everyone. In reality, the concept of cheap money is not about an easy to get payment for your work, but about the cost of borrowing money. In other words, it refers to a situation in which the central bank from a country lowers the reference rate of interest to a level at which banks can offer credits with interest rates that are close to zero. The purpose of the measure is to stimulate investments in the economy. In this scenario, investors can easily take loans and direct them to the productive sectors of the economy. Of course, there is a long way to go from theory to practice. Cheap money is seductive and it has dangerous effects in the economy. For example, a side effect of cheap money appears in the real estate market. Because the loans are cheap and the monthly rates are low, individuals start buying houses that are more expensive than they can afford. The demand increases and the prices of the houses reach the sky. Sounds familiar, doesn't it? Later on, when the central bank increases the reference rate, the monthly costs of the loans grow and we find out that our houses are overvalued and we can't really afford them. Another example is related to the investors. When money is easy to obtain, the speculative behaviors increase, meaning that investors are ready to make bets on more risky businesses. Some businesses without real prospects end up attracting large sums of money and a speculative bubble is formed on the market, which has the potential to degenerate into an economic crisis. That's about it for today. Thank you for watching and don't forget to subscribe to our channel.